What is better for investors, stock dividends or stock buybacks? Well, unfortunately, there's no hard and fast rule based on performance figures in terms of what is better for stock investors. But I would have to lean towards stock dividends. If you look at the right companies paying dividends over a 10-year period, you can find that perhaps the company you invested in is now giving you a yield of maybe 7, maybe 8% based on your initial investment. Those dividends can be a really great tool for long-term investing. And while companies could always stop the dividend, most companies that have paid a dividend for long-term do not like to stop or even reduce paying that dividend. This can help stabilize returns during those downturns and may help investors be less emotional. A problem with stock buybacks is they can be announced and the stock may seem, well, it might see a little bounce, but then it's possible that management does not fulfill the commitment to buy back all the shares they had planned to. Also, if the company or markets would hit a rough patch, well, many times the first thing to go is the stock buybacks. It's also possible that the company could do a stock buyback, but within a year or two, the stock might drop below the price where the repurchase occurred, which, well, would make those investments a questionable use of capital. Benefits to stock buybacks, well, there are some. They include the fact that there's no taxes for shareholders when they occur, and they do increase, which I think is an important thing, they do increase your ownership of that business. While dividends are generally taxed, they are tax favored, and depending on one's tax bracket, you may pay very little or maybe pay no tax at all. And don't forget about the compounding effect of reinvesting those dividends back into another investment. Unfortunately, it has become harder to find good quality companies paying dividends for a reasonable price. Looking at the S&P 500 index, the yield is now 1.2%, only 1.2%, which is near an all-time low that was hit during the dot-com bubble, and we know what happened there. Over the long-term history of the S&P 500, its yield is generally around the 10-year Treasury, and I was surprised to learn that up until the 1960s, the S&P 500 actually generally yielded more than the 10-year Treasury. Even looking just 10 years ago, they're both yielding around 2%. But currently, the spread between the two, well, it's about a 3% difference. This comes as the S&P 500 has seen its forward PE based on the next 12 months of earnings expand from 17 to around 22 during that time frame. Could this be another warning sign that the S&P 500 index is overvalued? I'm Brent Wilsey with Wilsey Asset Management. If you like these videos, be sure to hit a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.